I don't know if you've had this experience, but if I post something about dividend investing online, pretty soon the total return police show up. And they don't like dividends. And they will tell you about it. They will tell you that dividends are outdated, irrelevant, irrational, that if you want income, you should just sell your shares. That's what Warren Buffett says. Well, usually I ignore them, but what if they're right? What if dividend investing is dumb? What if we're wrong? Well, today, we're going to run the numbers, we're going to look at the facts, and we're going to find out. And if you're already interested in dividends, then use the link in the description to get my Dividend Investors Toolkit. It has a guide to analyzing a dividend stock, a checklist for you, a 5-stock case study, and even a spreadsheet of all of the dividend aristocrats. It's free, so go pick it up. First up, taxes. The anti-dividend crowd always starts here. Dividends get taxed. They'll tell you that like it's a surprise and like you didn't know. But here's the thing. So does your paycheck. So do capital gains. Everything gets taxed eventually. And I don't hear anybody telling you that you should quit your job so you don't have to pay taxes. But let's see if this really is a big deal. And I'll be honest, typically I ignore taxes because we have viewers and readers from all over the world, and this can vary a lot. But for this example, I'm going to use the US rate of 15% on dividends. And we're going to assume that you hold these dividend stocks in a taxable account. Now, of course, you can avoid this if they're in your 401k or an IRA, but this is kind of worst case scenario. So let's see how big of a deal this really is. So we're just going to put $100,000 into that taxable account, and we're going to assume that we start with a 3-year dividend yield and that we're going to get 7% growth in price and that the dividends are going to grow at the same 7% rate. So overall, our total return should be 10%. We've got the 3% dividend yield, we've got the 7% growth. Let's fast forward 20 years and see where we end up. Now, I'm assuming that we get taxed and then reinvest our dividends. And what ends up happening is that we've got $623,000 in the account, plus we have $19,000 in annual income from our dividends. That gives us a total value of over $641,000. That's not bad. Now, we're going to run the same numbers, but instead of the 3% dividend yield, this portfolio is going to be growth only, no dividends at all. And the price return is going to be 10%. So 10% price appreciation, no dividends, we're at the same 10% total return. Let's fast forward 20 years and see where we end up. So in 20 years, this has about $672,750. Looks like a win for growth. They've got about $31,000 more. But these aren't equivalent.
This is where we need to talk about the difference between real returns and theoretical ones. The scenario I ran looks like the top picture. It's nice and smooth. There's no dips. It's very predictable. But in the real world, the markets look like the bottom picture. There's ups and downs. It's a wild ride, and it's not the nice, smooth ride that our theoretical calculations portrayed. And this matters a lot. Dividends are taxed because you actually got a return. You got actual cash in your account. And in this scenario, we chose to reinvest it, but you could save it, you could spend it, you could put it in bonds. It's a real return in your hands. With capital gains, the IRS doesn't have anything to tax because you just have numbers that have gone up on a screen. The share price might have gone up, but you don't have real usable returns until you hit the sell button. So until you do sell your shares, your return is a maybe. It's not a guarantee. And that means that some portion of your outcome depends on timing. So that growth only account probably looked really good in 2021, but in 2022, it was probably a little bit of a different story. And we'll talk about that more later, but if you needed cash when the market was down, well, being a forced seller there, it's not a good place to be, especially when we look at your future returns moving forward. Now, think about the dividend investor. Over that 20 years, That person got $165,000 in actual, real, spendable cash, and they never had to sell a share. They got part of their return along the way. The growth only investor deferred all of their returns. Time reduces the value of money. $1 today is worth more than $1 tomorrow. This is a pretty important and basic economic concept. That $165,000 that the dividend investor received, but the growth investor waited to get, well, for the growth investor, it's not worth $165,000 anymore. You have to discount it because of that time value of money. So yes, the growth portfolio shows a higher number, but it should, because you waited 20 years to get any returns out of it. Dividends might come with an immediate tax, but they also come with the benefit of real, actual cash in your account along the way. You get a return that's not dependent on the market. Now, I'm not arguing necessarily that one's better than the other or that you should go in all one direction or all the other. But what I am saying is that in real practical terms, they're not at all the same. And you should think about the differences. And we'll come back to this idea of selling shares for income and what the market's doing at the time in a bit.
Before we do, we're going to deal with the price drop myth. The classic, but when you get paid a dividend, then the stock price is going to drop by the same amount. It's irrelevant. It doesn't matter. This is one of my favorites. So if we assume everything stays constant and that the market is totally rational and that the only thing that it's pricing the company on is the balance sheet, then an accountant will tell you, yes, at that very second, when that dividend is paid out and it leaves the company, if you get $1, the stock price adjusts down by $1 because we can't create money out of nowhere. That's theory. But we operate in the real world, and that's not how the market prices stocks. In the real world, stock prices move on expectations, earnings, future growth, news, emotions, announcements from the White House, all kinds of things that have nothing to do with the dividend. And if this really happened, I would love it. I did a whole video, but here's the short version. Think about this for a second. If every time a company paid a dividend, the stock price went down, the yield goes up and up and up. And as long as the company keeps being profitable and keeps paying dividends, eventually this company is going to wind up with a 20 or 30 or 40 or 50% dividend yield. And that's just not going to exist in the market. If you can get a 50% dividend yield on a company that's paid out a dividend for the last 5 or 10 years in a row, that's going to get bid up real quick. So this is just a theory and it doesn't actually happen in the real world. Now we can tackle the just sell shares. That's what Warren Buffett tells his shareholders, right? The anti-dividend people will tell you, just focus on quality companies and don't worry about the dividends. They're irrelevant. If you need cash, just sell your shares. Well, I agree that you should buy quality companies, but let's look at the sell your shares for cash thing for a second. There's kind of a problem with this. And the problem is that they don't really consider what happens if the market drops. Let's see how this plays out in two scenarios. Now, this is really relevant, especially for retirees. What we're going to do is we're going to take these two portfolios, and these investors both get the same return over the same time period, and they withdraw the same amount of money from their account every single year. The only difference here is the order in which the returns happen. And the takeaway here is that if you have a down year early in your retirement, you wind up with significantly less money than if those down years happen later. And that's because you have to sell a lot more shares to get the same amount of money when those shares are worth less. This is called sequence of return risk, and it's very real and it's very dangerous. This can be the difference between a comfortable retirement and running out of money. And you don't have any control of it. You have no control over what stock prices are going to do in the first few years after you retire. Now, you know who doesn't care about this at all? the investor that has a 5% yield on that same portfolio, because they're going to get the same amount of cash that investor A and B did, and they're not going to have to sell a single share ever. So selling shares and getting paid a dividend are not the same thing. You might end up with the same amount of cash at the end of the day, and you may pay the same taxes, but one comes from the results of the business, one comes from the results of the market. And I personally believe that the results of the businesses that I invest in are going to be much more stable than the results of the market. Let's tackle another favorite, that instead of paying the dividend, they should just buy back shares. It's more advantageous, it creates more shareholder value, it's tax efficient, buybacks are wonderful, and dividends are dumb. Well, I love a good buyback as much as anybody, especially when it's done right. But buybacks are a capital allocation decision, the same as dividends, and they can be smart and they can be not so smart. And it depends on the management. Management gets to decide, and management has to get it right. So when should a company give a dividend and when should it return capital through buybacks? Well, our friend Brian Ferraldi has a great flowchart that walks through this. You can see it here. So if a business has invested in the attractive opportunities available to it, it doesn't need to pay off debt, and the profits are sustainable, then we get to the capital returns phase of the flowchart. And the decision here is pretty straightforward. A regular dividend is a great start, but if the stock is significantly undervalued, then buybacks can create significant shareholder value, and I'm all for them. But this goes back to the whole market thing. The management has no control over when the market gets cheap. And if they either don't have a buyback authorized, or if they don't have very much left in the authorization, then they may not be able to take advantage of it. You know, some companies do programmatic buybacks, which might not be a bad idea. It's similar to a DCA strategy for an individual investor, but neither one or the other is necessarily always good or always bad. This is a capital allocation decision that relies on management. So what if you're still unconvinced? What if you just say, nah, I don't like it, dividends are bad, I'm going to avoid them? What are the consequences of that? Are there any? Well, number one, by avoiding dividends, you're definitely avoiding returns. If we look over long periods, dividend returns and the reinvestment of the dividends have been around 50% of your total return. So if you're one of those total return people and argue that dividends are bad, that's half of your total return over long periods. The other thing to consider here is that if we look at how much of the return it is over every single decade, this varies a lot. 25% is kind of the low end, but in decades where price returns are negative, dividends were actually 130% of the total return. That's not something I really want to give up. I don't know about you. Second, dividends tend to beat the market. If we take stocks and we rank them by dividend yield, highest to lowest, and we break them up into quintiles, so 20%, the top 60% of dividend yielders tend to beat the market more than half of the time. And if you think about it, this makes sense. If you can consistently pay out a dividend, then you're consistently making profits. These are good companies. And by avoiding these dividend payers, you're avoiding a lot of stocks that do better than the average market. Again, not a decision that I necessarily want to make. Third, and this is crucial for investor behavior, if you intentionally avoid dividends, you're intentionally signing up for higher volatility. Now, I'm not making the argument that volatility is bad or that volatility is risk. That's simply not true. If two stocks wind up with the same return over the same time period, then theoretically it doesn't matter how they get there. But if one's a very smooth ride and one's a very volatile ride, the smoother stock is the easier one to hold on to. And the only way to wind up with ultimately the same return is to actually hold the stock. And if you want an example, let's look at 2022. This is Vanguard's growth index versus the dividend aristocrats. And you can see that the growth index dropped 40% and the dividend aristocrats only fell 20. Now, which one of those two do you think is easier to hold on to? And which one do you think people actually held on to? The really volatile one that gives them no cash, or the one that pays them to hold it? And so what have we learned from all this? Well, yes, dividends get taxed. And yes, theoretically, the dividend can cause the stock price to drop. And yes, you can sell shares and raise cash. But when we look at the actual numbers, when we consider the facts, and when we think about how humans actually behave with their money, not just what the academics tell you that they should do, well, then I think dividends win, or at least tie. They're definitely not dumb, they're definitely not irrelevant, and they're definitely not a terrible way to invest. And again, if you are interested in dividends, make sure you get that Dividend Investors Toolkit for free with the link in the description. You'll get the guide to evaluating dividend stocks, the checklist, the spreadsheet of all the dividend aristocrats. It's really handy information to have. Dividends give you income without having to sell. They add stability to your portfolio. They make it easier to behave in the right way. And they protect you from one of the biggest risks to retirees, and that's sequence of returns. You don't have to hope that the market's up when you retire. You don't have to hope that your stocks are up when you need cash. You just get paid quarter after quarter without lifting a finger. You're not just investing in stocks. You're actually becoming an owner of great businesses that share their profits with you. You rely on the business performance, not the emotions and ups and downs of the stock market. Dividends work. They always have, and they always will. If this was helpful, don't forget to hit the like button. Don't forget to subscribe, and let me know in the comments. Are you a dividend investor? Do you prefer pure growth? Do you mix the two strategies? Online, we tend to be really one way or the other and polarized, but in the real world, again, that whole theory versus practice thing, it's okay to be in the middle. You can have some growth and some dividends in your portfolio as well. I know you were waiting on my blessing, and I allow it. Thanks for watching. See you next time.